Welcome to Introduction to Farm and Ranch Taxes.
Hi, I'm Poppy Davis. I teach a class in agricultural taxation at the University of Arkansas School of Law LL.M program in agricultural and food law. I'm the primary author of these materials in close collaboration with my friend and colleague Winona Doris. Winona is a business skills consultant and trainer who works with farmers, ranchers, and fishers. She leads training on accounting, taxation, insurance, and cash flow at both the state and national level. Winona comes to agriculture through familial ties from her great uncle, Ed Scott, who was a successful claimant in the Pigford case against the USDA. Winona holds a BA in economics and accounting, a master's in business administration, a graduate master's certificate in taxation, and is licensed as an insurance agent and a tax preparer.
And it's my pleasure to introduce my friend and colleague, Poppy Davis. Poppy is a consultant and business skills advisor to agricultural and food and beverage enterprises and to nonprofits and local governments. She has worked as a CPA and at the United States Department of Agriculture and in various nonprofits. She holds a Juris Doctorate from Drake University Law School, a master's in journalism from Georgetown, and a BS in agricultural economics from the University of California at Davis.
The LL.M program in agricultural and food law at the University of Arkansas School of Law has been a leader in agricultural and food law for more than 40 years. It has nationally recognized faculty, specially designed courses, on-campus and distance options, and for more information, you are encouraged to go to the website.
This presentation is intended to provide general information on agricultural income tax issues and should not be construed as providing legal advice. It should not be cited or relied upon as legal authority. State laws vary and no attempt is made to discuss state-specific laws. For advice on how these issues might apply to your individual situation, consult an attorney. This project and materials created by Poppy Davis as part of the LL.M program of agricultural and food law at the University of Arkansas School of Law is part of the Agricultural Finance, Tax, and Asset Protection Program.
The Ag Financial Tax and Asset Protection Program has resources to enhance farmers, ranchers, educators, and others' ability to understand and navigate business tax and asset protection decisions.
There are a total of 5 lessons in this series.
For each lesson, there's a short questionnaire to help you decide if the lesson is right for you. Each lesson also includes a PowerPoint, a recording of the PowerPoint, and a PDF file with detailed supplemental information, including the presenter's script, additional topics for discussion and engagement, and additional resources.
Welcome to Lesson 5, Defining Agricultural Income and Understanding Related Special Rules.
There are a total of 5 lessons in this series. This training covers the tax definition of agricultural income and why that definition matters.
Agricultural income is income from the sale of crops or livestock which you raise. Is wine a crop? Is cheese livestock? Is hosting a wedding farming? Is teaching a class on pasture management ranching? Why does it matter? It could affect how much you owe in income taxes when you have to pay your income taxes, if you qualify for special debt relief and bankruptcy protection, and if you qualify for federal, state, and local programs. How much does it matter? It ranges from not at all to very much.
Cheese and wine are not considered raw agricultural products, and for federal tax and many other purposes are not agricultural income. Income from renting land for agritourism, hunting, events, and other things is not agricultural income for federal tax and many other purposes.
If you take advantage of any federal tax benefits that are based on the IRS definition of agricultural income, and you have overstated your agricultural income, then you may be liable for fines and penalties and repayment of the benefit.
If you do not get any benefit from including farm and ranch and non-farm and ranch income together, then the only real harm is probably to you. You may be missing out on benefits to which you are entitled, or you may be limiting your ability to access benefits in the future.
Processing that is incidental to the growing, raising, harvesting process is still considered a farming activity. Examples are field packing, washing, cooling and putting to standard packs as required by marketing standards or local custom. Once you are beyond that, doing more than is required to get the raw agricultural product to market, doing things that alter its physical form and extend the time it can be held for sale, you may be into activities which would not qualify as farming or ranching for federal income tax purposes.
For example, you might have to wash and cool and package a product for that product to make it to market. Think about fragile ripe fruit. But you do not have to turn it into jam or pie. Washing, cooling, and packing are all part of the agricultural income. But if you make jam or pie, that income is not agricultural income. In small operations, it may be hard to separate the accounting for a small amount of value-added activity.
If you are just experimenting with new product, it may not be practical to set up elaborate accounting before you know if the product is going to work out for you. If the value added products you make have a short shelf life and sell about as fast as your fresh farm produce, there may be no practical difference between separating the accounting and tax reporting and keeping it all together.
Income from renting your land for other uses is not farming or ranching income. It may be rental income or other self-employment income, depending on the circumstances and your degree of involvement.
Common examples are renting your land for hunting or camping or weddings.
Rent you receive from agricultural land you lease to others may be agricultural income to you if you are paid in crop proceeds. This is called a crop share, and you report income and expense from a crop share on IRS Form 4835.
Farm income is reported on Schedule F or Form 4835, and those forms are used to verify if you qualify for special benefits only available to farmers and ranchers. Income from non-agricultural activities may not be reported on Schedule F or Form 4835. Agricultural income may be reported on a Schedule C rather than a Schedule F. However, doing so may prevent you from accessing benefits and services to which you would otherwise be entitled.
Farm income may also include gains from sales of draft, breeding, dairy, or sporting livestock that are reported on Form 4797. Next, we will talk about some of the benefits that are available based on your farm or ranch income.
We've already covered two of these. Does anyone remember what they are? The answer: filing taxes on March 1st to avoid paying estimated taxes, and optional self-employment tax using the farm method.
If approximately 70% or more of your gross revenue from all sources is income from farming, ranching, or fishing, then you have some options for making estimated payments. You may, 1, elect to pay quarterly estimated taxes. 2, make one large estimated payment by January 15th. Or 3, not make any estimated tax payments and file your tax return on March 1st and pay the full amount due on March 1st.
This is a good option for people who earn all of their income in the fall. People who earn throughout the year may be better off paying quarterly estimated taxes and keeping the option to get an extension of time in which to file their tax return.
For more information on estimated taxes, see the IRS website.
Because paying into Social Security and Medicare is essential to maintaining a safety net, and because farmers, ranchers, and fishers often have years in which they do not earn much self employment income, even though they were working, there is a special benefit, the ability to make optional payments into the Social Security Medicare system. To qualify to make optional Social Security Medicare payments, gross income from farming or fishing must be approximately $9,000 or less, or net farm income must be less than approximately $6,000. Those who qualify may make an optional payment on 66 2/3% of gross income.
Rental income is generally not subject to self-employment tax. However, qualified farm rental income can be used as part of the gross income for purposes of calculating optional self-employment taxes using the farm method. For exact numbers and additional information, see Pub 225 and the resources at ruraltax.org.
Farming and ranching income can fluctuate drastically. In years with significant profits, farmers and ranchers pay taxes at higher tax rates. In other years, they may pay taxes at lower tax rates, or they may have a loss.
Income averaging and net operating loss carrybacks are two ways to help smooth the tax burden over a few years. Both require you to recalculate prior year taxes based on current losses, and both allow you to get a refund of prior taxes paid. You will need to consult a tax professional for assistance in completing the forms correctly. For more information on income averaging and net operating losses, see the Pub 225.
In general, if your debt is canceled, forgiven, or discharged for less than the amount you owe, the amount of the canceled debt is taxable income in the year the cancellation occurs. A debt is qualified farm indebtedness if 1, the proceeds were used directly in the farm business. This includes purchase of land and assets as well as operating loans.
Or two, at least 50% of the debtor's gross receipts for the prior 3 years were from farming. And also, the lender is in the active and regular business of lending money, and the lender is not related or otherwise connected through business or other asset ownership with the debtor.
In lesson 2, we talked about a special rule for how farmers can deduct a certain amount of prepaid supplies.
There's a special rule for bankruptcy. Chapter 12 bankruptcy is a special option available only to farmers and ranchers meeting certain criteria related to agricultural income. Chapter 12 was written in response to the farm crisis of the 1980s and is generally a better option than other forms of bankruptcy when the business needs to continue operating in order to continue making payments on debts.
You can learn more about Chapter 12 bankruptcy at the National Ag Law Center.
There are also various USDA programs that are open to farmers and ranchers based on their agricultural income or the agricultural use of their land. The Farm Service Agency generally lends for assets and activities directly related to raising crops and livestock for sale. The Natural Resource Conservation Service may extend services to agricultural land owners who are not in the business of farming and ranching.
Agricultural Marketing Service makes awards specifically for value-added production using a very different definition of value add than the IRS definition. And the Rural Development lends to non-farm ranch businesses in rural areas.
For sure, an agricultural lender will expect to see agricultural income reported on a Schedule F or a Form 4835. You may still get an agricultural loan if you have used the wrong form, but you will make a better impression on the lender if you use the correct form.
You need to know if income from agritourism or value-added production is allowed to qualify you for a state program or not. If it is not allowed, you need to be able to separate out that other income so that you can see if you qualify just on the allowable agricultural income.
A community may pay a landowner to keep the land in farming, but the landowner may find that even with that payment, the farm is still only profitable if there is a big harvest festival with rides and concessions and entertainment. The community might object to that use of the land. They wanted a farm, not an amusement park. So an easement will usually have language that limits how much non-farming activity can take place. And that language may be specific about income from non-farming activities.
You may be eligible for breaks on local property taxes based on your agricultural income. You should check the specifics of the local rules to understand how agricultural income is defined for purposes of local property taxes.
You may need an inventory management system in order to run your business profitably and efficiently. The tax code used to require people to use inventory accounting, even if they had only very small inventories. But since the 2017 Tax Act, businesses with less than 25 million in sales do not have to use formal inventory accounting. Just because the IRS no longer requires it does not mean that you wouldn't need it for good management and common sense.
We introduced some of the special tax rules related to inventory in lesson 2. In lesson 6, we will go deeper into these rules.
There are 5 lessons total in this series. For additional information, you can go to the links provided in your materials.
You can see IRS Publication 225, the Farmer's Tax Guide. You can also go to ruraltax.org or the IRS website with its forms and publications for additional information.
Thank you.